Okay, hello everyone. Welcome back again on to your series of chapter 9 on business combination. So we are going to be in the final video of chapter 9, and in the last video we talked about deferred income taxes, and now we are going to jump into the segment disclosures. So now the companies are required for extensive disclosures. One of the disclosures is mostly focused on the segment. So when the company is involved into the different operations, then they have different segments, and the segments could be considered as a different operations, a geographical area of the business, and if they have a different uh, operations happening in different countries, and they have operations which are different in their natures, and then the users may want to know where the company's risk is, what kind of operations it's involved in, and the profitability that's being contributed by each segment of the business that need to be disclosed. Okay, so now there are different requirements that the company has to look at, and if it meets those criteria, then you have to have disclosures of those particular segments. And then when it comes to the reporting those segments, then there are different parts of those segments that need to be disclosed as well. So those are the things that we are going to look at in this video, and then we'll finally wrap up the chapter 9 to see what else is left from chapter 9. So when the consolidated financial statement of a large and diversified companies are prepared, a significant amount of details about the profitability of different products and services, the geographical areas in which the consolidated operates, and its customer is aggregated as well. So all those informations are very important to the users, and it provides the users about the risk that the company is involved, what kind of different types of customers that it's servicing, and then also knowing how much its profit is coming from those different segments. So in that case, there are separate disclosures that are required for the user to predict that information, analyze the company's risk and the profitability based on the financial statements that's prepared. So in that case, if this is the part, then it provides individual financial statement of subsidy. So now there's two ways that this information can be useful. Is one, we know that when the company is involved into a different subsidies, joint ventures, it must provide the disclosures about all that information. So what it could do is it provide a consolidated financial statement, then it could attach the subsequent financial statements of those subsidies as well. Okay. Now when they do that, it will not provide all the information. It may just provide what the company's financial statements are for those individual entities. So what the users wanted to do is the user wanted to know the risk, the profitability that is being contributing towards the company as overall. So therefore the consolidated financial statements are important, that is disclosed, but it's not as relevant as providing the segment disclosures. But the other part that's important as well when these informations are being disclosed, you don't want to be putting too much information that the competitors can use for their own benefits. So you wanted to make sure that you put a limitation of how much information you wanted to put in there, and then what's relevant for the users versus putting the company at a risk. So those kind of things that you must be considered when you are looking at the segment disclosures. But then we're going to look at what is the requirement as per the IFRS. So segment reporting is an efficient method of communicating enough but extensive information that's relevant to the users. So if you just put everything on the segment disclosures, then you're putting yourself at a risk. But what you do is you will communicate it in a way that you just pull up the information that's required for the users, but it provides enough information that determine what the company's profitability is coming from different segments. So that's why segment reporting becomes very important. You want it to just customize in a way that is important for the users, and you are not losing any confidential or sensitive information that could be benefiting to the other competitors in the market. So under the IFRS 8 requires a separate disclosures that's required one of the companies to provide certain disclosures. So To do a segment disclosure under IFRS, it must meet one or more of these thresholds to do a segment disclosures. One talks about the reporting revenue. If both the external and the intersegment is 10% or more of the combined revenues, then you are required to do a segment disclosures. The absolute amount of the reporting profit is 10% or more of a greater in absolute amount of the combined reporting profit of operational segment, or is a combined reporting loss of an operating segment that does report a loss. So the 10% is more applicable on the profit, not on the net revenue. So if you have one particular segment that's contributing more than 10% towards the profit or a loss, then obviously the segment need to be reported as well. Then the next part we have is the assets. If 10% of the assets are combined from one operational segment, so if it is the case, then obviously then there is a segmental requirement. Then the last one we have is the talks about the external revenue. If at least 70% of the company's external revenues are reported, then there is a segment requirement is required as well. So what are the things that's required when we're doing a segment disclosures? The factor used by management to identify a particular segment. So if we say that the segments are going to be considered as the countries or the regions that provide services, then it will decide must be disclosed to the users how you identify those segments. So if I say that North America and Europe are the two different segments that I'm reporting, then I need to identify what is included in the one segment versus the other segment, and what are the measurements that they use to identify those segments. If you're using the type of products or services that generate the revenues, then you will identify that as well. The measurement of the profit or loss. So if you are dictating how much revenue, the profit or the loss is coming from each segment, then you must disclose that and provide the profitability and how you determine those profit from each segment. The total assets, total liabilities. When you are identifying those assets, then you provide how much of the revenues that's provided by those segments, how much is the profit that is provided by the segment, what are the total assets that's in that segment, what are the total liabilities that's involved in that segment as well. Then further to that, you provide each of the following of the specific amount that's measured in the profitability. So you will find out how much is revenue coming from the external customers versus internal customers, and what are the inter-segment revenues. If there are intercompany segment revenue that exists, you must describe that as well. Interest and revenue expenses, depreciation. So all the information that's relevant for each segment that must be disclosed in the financial statement disclosure. Income taxes, the equity methods associated. So these are actually the other disclosures that exist. So it's not simply talking about the segment disclosures, it talks about all the other disclosures. So this part was relating to the segments. The next part that we have is we talk about the other disclosures. The amount of investment associated. So now this is talking about if you have investments in the other companies, what kind of investment they are and how these investments are being accounted for, if they are using the ventures or by the equity method. If there's non-current assets, what are those assets, what are the financial instruments, and deferred income tax assets, and any post-employment benefit that exists, you must provide the disclosures for that as well. An explanation of how segments profit and losses are measured and how common cost and joint use assets have been allocated among, and what are the accounting policies behind that as well. Recognizing of the reconciliations of the following. So if you are doing a reporting segment, you must provide a reconciliation statement as what is the total revenue for the company and how this is being divided between the different segments. So it's not simply focused on the revenue but also on the profitability. So you're kind of creating a matrix, and that looks at the total of the company and then divide that between the different segments. So when you are doing a disclosures, you also look at the following as well for the segments. The following information must be disclosed even when there is only one reporting segment. So now if you say that we don't have multiple segments, but we only have one company and we are only reporting the total of that. So if there are certain customers which are important or a group of customers, then you must disclose what the revenue is coming from those group of customers or a particular customer if that person that customer is an important part of your company and contribute towards 10% or more of the company's revenue. The revenue from external broken down by the company's home country versus other countries. Say the company has operation outside country but it's not major, it's important you will just put the total revenue coming from your home country versus other countries. Goodwill, so if there's goodwill exist and you are involved into different segments of the company, you must want to show how much of those property, plant, equipment, goodwill, and any other asset that exists, and allocate between the home country and the foreign countries as well. So this was what I was talking about the customer. If you have a revenue that's coming from one particular customer that's more than 10%, you must put a disclosure to it so that the users know the risk that you are involved in, and then you just report the total revenue coming from that customers, and then also any revenue that's revenue from each customer and which operates segments reporting such revenues, and then identify the customer doesn't have any disclosure. The identity of the customer does not have to be disclosed. So yeah, so you don't need to disclose the full identity. You simply say that the company has a customer that has the majority of the revenue coming from, and you can just put the amount and the percentage of the revenue that's coming from that customer. So you don't need to identify the customer, but you will disclose the revenue that's coming from that particular customer, the percentage. So finally, wrapping up the chapter 9 on analyzing and interpretation of the financial statement. So under the IFRS, the equity method must be used for reporting investment in the joint venture, whereas the form of proportional control is used for reporting investment in the joint venture. So if there is no control exists, you must report the investment in the joint venture using the equity method. If there is a joint control exists, and then you will end up recording the investment on a consolidation basis. And how does that consolidation work is based on the proportional method. So it does impact on the financial statement as well. So depending on which method you use, if it based on that method, you must determine which one is going to create more better ratios for you. So you will look at the interpretation of that. The equity method reports income from the joint venture on a line-by-line basis, whereas the income from a joint operation is reported on a line-by-line basis as well. So okay, now the equity method will report the income as a total amount. It still be using a proportional method, but it will just take the percentage of the total income from operations, income from discontinued operations, from non-operating activities. It will just do a one line. Whereas if it's a joint operation, it has to be done on line by line basis. So technically you will increase your revenue by your percentage, you increase the expenses of your company by the same percentage. So it's going line by line versus a one line number. Okay, so it plays a key role of how the reporting works. Net income and retained earnings under the equity methods are equal to the proportional adjustment. So technically at the bottom number still be the same, doesn't matter which method we use, either be using the equity or a consolidation, it will still give you the same result at the bottom. Okay, so this wraps up your chapter 9, and now I recommend all of you guys to go back, finish your reading on chapter 9. Actually, chapter 9 is a very good reading. It provides a lot of information, so we may not able to do a lot of questions on this, but I will definitely focus on theory from this chapter, and then I'll post a video, post an announcement about regarding the homework question that I'm going to be assigning from this chapter. So watch for that. And when I see you guys in class, if there's any question that you want to raise or wanted to discuss, bring it to the class, and we'll definitely talk about those ones. Okay, take it until then, and we'll see you in class soon. Bye bye.